Hello, 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 you all. I hope that you are having an awesome and amazing day. So, I received this question via email. I'm going to take time to shoot this quick video to respond to it and answer that question. The question was, great question, is what is the difference between amortization interest that you receive or you get when you take out a mortgage on a house versus the interest? How does that work on versus simple interest, right, on a credit card or a vehicle loan, right? Um, Great question. So let's get right into it. Now, when you take out a mortgage on a home, on a house, right? Mortgage is root word for mortier, which means death pledge, and French. That's the etymology of the word mortgage, death pledge, right? So most people, including myself, when I first purchased my home, look at the interest rate, right? They look at the interest rate. So if they're at 2%, 3%, 5%, they think, oh, this is a wonderful deal, especially if they get like 2%, right? This is a great deal. I'm paying very little interest on my home, but that's not how that works. So let's say, for example, you ask to borrow $1,000 from me, right? You want to borrow $1,000 from me. And I tell you that, okay, cool, you can borrow $1,000, but I'm going to charge you 20% interest on that $1,000. Now, in your mind, you're thinking, okay, 20% times 1,000, I'll pay $200 back. I can do that. That's feasible. And you decide that you're going to pay $100 a month towards the $1,000 that you borrow from me for 12 months, which will equal $1,200 because I told you 20% interest, right? So you pay for a year, and at the end of your 12 months, you think you're free and clear. And I tell you, no, you still owe me $760. You're like, huh? How do I owe you $760? Well, then I go on to explain. My 20% interest rate is calculated daily in the loan. So when you was paying me $100, only $20 of the 100 was going towards the original $1,000 that you borrowed. That's called the principal amount. The $80 was going towards the interest. How would you feel? Well, that's how the banks do you on a mortgage. The 20% interest rate is calculated every day, right? And it's calculated up front, meaning that when you was paying me the $100 a month for the $1,000 loan, it was already built in the repayment every month that only $20 would go towards the original amount, the principal $1,000 that you borrowed from me, and then $80 would go towards the interest. But you didn't know that. Works the same way with the house. You have a $200,000 loan, for example. Even at 2% interest, that's $40,000 upfront that's built into your payment. So when you're making a $1,500 or a $2,000 payment, you think that's going towards the $200,000 loan, and the interest is 20%. So let's say $1,000 to have it round and even. You pay $1,000 on that loan. 20 to 30% of the thousand, which is um, $200 to $300, is already built in the payment up front. So only $700 approximately is going towards the original principal amount, and that's how the banks get people. That's how the banks get over. That's why people pay double for mortgages at the end of a loan. So you may ask, now this works different with credit cards, and you got what's called installment loans, and revolving loans. But the interest work different. Revolving means that once you pay the balance down, like your credit card, your lines of credit, you can use it over and over again, liquidate it. You can revolve, always using. A vehicle or a regular loan, installment loan, once you pay it off, you're done. Now, credit cards, APR, annual percentage rates, for example, let's say 20%. So if you have a $5,000 balance, right, that's $1,000 of interest that is already charged annually, right? Now, with this being said, um, okay, I'll read the comments later. That $1,000 is calculated in the balance on a daily basis. So the more you pay down that credit card balance, the least amount of interest that you're charged. It does not work that way at the mortgage. Your interest is stacked up front in the deal. The only way, the only way to get that interest lower and reduce and to pay off that mortgage in 5 to 7 years is to pay down that principal, the original amount. So you should call your mortgage and ask them, do you accept principal only payments? You have to say it that way. Because remind you, you still have taxes, you still have your escrow. And then at the time that I purchased my home, or yeah, we also had to have PMI, private mortgage insurance. There's some more additional fees, right? And the PMI did not go away until we paid down a loan. So if you can eat at the core amount that you borrow, when your principal is lower, then the interest rate will be lower as a result. And that's the plan that you can pay down. So with credit cards and vehicles, same thing. On some of your vehicles, once you pay down the principal of it, your interest rate is not uploaded up front like a mortgage is. The lower the original amount, the least amount of interest. So with a credit card, you may be charged $20, $30, $40 interest. But if you pay down that amount more, then the amount of interest for the next month will be decreased based off the balance. But it does not work like that in the mortgage because the mortgage is upfront interest. Okay, let me read this comment real quick because I have to go. The 12 U.S.C. 1431 states the power and duties of banks. They are supposed to pay interest. How are the banks supposed to pay interest? Latour, before I hope I'm pronouncing it right. How are the banks supposed to pay interest? How would you feel if you found out that when you went to closing, your house was free and clear and you sold it to the bank for $10? If it was free and clear, why would you sell it to the bank? I'm going to wait on these two responses because these are only comments. Um, why would you sell it to the bank? Oh, you're saying your house was on the market for sale and the bank bought it back from you for $10? I don't understand that comment. Like, was your house on the market to sell? And why would the bank want to buy it? I'm confused. Why wouldn't a person buy it? How would you feel if you found out when you went to the closing, your house was free and clear and you sold it? Why would you sell it to the bank? Okay, I'm gonna give y'all a couple of seconds comment. If not, I'm logging off because I said this live stream was gonna be quick. So again, I hope that helped you out understand amortization interest versus and compound interest and simple interest. And the reason why you need to understand is because the people that understand it pays it, that don't understand it, I'm sorry, pays it, and the people that understand it earns it or they get it. They get it through investing. They put their money where their money is always making money, right? Where their money is going back and getting friends and making more of it without them having to work. This is what the rich and wealthy do. They put their money in investing streams that compounds daily, right? Now, the people that don't understand compound interest, they pay it out. And that's what your mortgage loan does. This is very biblical, right? Matthew 25. I love teaching biblical from Matthew 25 and 2 Kings chapter 4. Matthew 25, the servant did not know how to grow his money. The first one grew it 5 times more. The second one that received gold from the master grew it 2 times more. The one that received 1 ounce of gold went and hid his money in the ground, and it grew no interest. It did not compound. And that's how many of the working class live and operate their lives. They never put their money in revenue streams where it can grow for them. So when inflation and the price of the economy of gas and groceries and your everyday goods and services increase, your money is not increasing with the increase in the pricing of the of inflation of the price of what things cost. And so because your money is not growing and it's sitting idle, or maybe you don't have extra money at the end of the month. So if you want to learn how to create cash flow right out of your paycheck, then go to milliemoves.com, where you can increase the money that you're already making without working overtime or getting a second job. Because now you can make a chess move, right? This is chess, not checkers. And you can reduce the taxes that come out of your paycheck to the federal government legally, morally, and ethically, and instantly, right? That's key. Every pay period. And by reducing it, you may shift that money back to you instead of giving it to the government. That minimal for people has been $500, right? For a married couple that did this, it was $1,100 back into their household. So there are legal ways, right? Because most Americans don't know 40%, just like a mortgage, all these built-in fees, PMI, escrow, right? They don't know their paycheck 40% before it even gets in their hand or direct deposit is gone away from federal taxes, and depends on what state you live in, state taxes. And then you have your insurances that come out. That's 40% of your paycheck. Health, vision, dental. And then people wonder why, and then they want to tithe another 10%. And they wonder why they can't survive financially, because you only got 50% of your paycheck every pay period from your labor. The government is taking 10 right off the top. And then the state takes some. And then when you go spend that money, you're taxed again. And then at the end of the year, you have to file a W-4 and you're taxed on the money that you're already taxed on. So this is how you get yourself out of the tax game. And then you get that extra money in cash flow now, because you've given yourself a paycheck pay raise. And then you take it to apply these principles to help you stop paying high interest and being a pawn to the banks and to debt and to loans and to interest, right? And then you get a financial IQ and you understand how interest rate works on credit cards and et cetera, et cetera. And then you take lines of credit, like credit cards, like I did, take a $5,000 Discover card. And I bought a real asset, which was a house, right? I took a $5,000 credit limit from Discover. How did you do that, Queen? I wrote a check to myself, pay in order of my name, deposit in my bank account. It came from Discover. And then I found a home, 3-bedroom, 2-bath. This was back in the day, right? You're not going to find it now. This was over 20 years ago. And then I wrote a cashier's check and purchased that home, and I flipped it and I sold it, and I profited 5 figures from it. That was my first real estate flip. So you take invisible money. This is Bible. It's called faith in the Bible. You take invisible and you make it tangible, visible. You take cash that doesn't grow. You don't hide it in the ground just to pay bills. And then you put it into things that will compound interest versus you just paying compound interest all the time. Another thing I said, 2 Kings chapter 4. The widow woman, her husband died. He didn't have a life insurance policy. That's not in the Bible. I'm just making it practical because the Bible, many people think the Bible is just mystical, spiritual. No, the Bible is a very practical book, and it'll help you financially and help you be as rich as the people in the Bible was rich. The Bible has many, many millionaires and multi-billionaires, multi-millionaires and billionaires. But anyway, so 2 Kings chapter 4, she go to the prophet, right? Elijah or Elisha, however you want to pronounce it. She said, my husband died. He doesn't have a life insurance policy. So now we're in debt. I'm in negative debt. I'm in bad debt. And my sons, the creditors, are about to come and get my sons to work for them and take my sons away. They all I got. They all I got. My husband is gone. See, as parents, we would take debt more serious if the creditors would come take our kids and work for them. Now, I just heard some parents say, well, mine need to learn how to work. Well, no, sometimes you need to teach. Some people, I think we need to teach our kids to be entrepreneurs and not employees. Right? Some kids, all they ever heard is, you need to hurry up and get you a job. Soon as they hit the age of 16 or age of legally working, get you a job. Why not teach them how to be an entrepreneur versus employee? Be a business owner. More than one way to make money. So anyway, the first thing the prophet told her to do was to grow her money. He said, what do you have in your house? What do you have to work with? She said, I just got a little pot of oil. He said, okay, let's take the little you have and grow it first. So a lot of people trying to get out of debt first. You need to first grow your money first. One crypto, for example, that I just looked at today is up 30% in one day. But you're worried about paying off a credit card that's charging you 16%. When you can just double that money, grow it, and then pay off the debts and get out of that bad debt. Because it's a such thing as good debt and bad debt. Depends on how you use it, right? Good debt is anytime you use a credit card or cash to make you money and grow your money. Bad debt is anytime you're into something, you buy something that takes away your money every time you get paid. It doesn't grow your money. The first thing he told her to do was grow your money. Let's take the little bit you have. You're going to open up a home-based business. I'm going to teach you generational wealth and teach your sons to be entrepreneurs, to work for you in the home-based business and not to go work for the creditors or to get a job and work for somebody else. Did you know if you had a home-based business, your children can work for you in a home-based business? And every year out of taxes, everybody, people hate paying taxes. They hate it. They open up their paycheck, they look at their tax. If I could just save this $500 out of I could, you can. If I didn't have to give $500 of tax, you don't have to. Now, everybody's situation is different. Now, this is not financial advice. So he said, let me show you how to make entrepreneurs out of your son and teach them to work for you in the family legacy. We're going to build a trust. So take the little bit you have, and then what's the next thing he told her to do? Because she was broke. She was broke. He said, let me show you how to use your credit to build a business. See, most people only want to use the credit to get things, houses, cars, vehicles. That's all you've been taught. What if you was taught this in school, the difference between amortization interest and simple interest and revolving credit and installment loans? And yeah, what if they taught you that in math? But anyway, so he said, go borrow. Borrow means credit, vessels, pots. And he said, don't borrow a small credit line. No, don't get a $5,000. He said, get the largest credit line you can get. Get 25, 30,000, 50,000, 100,000. See, you can only get those large credit lines if you do business under a corporation and a tax ID number, EIN, not your SSN number. And he said, borrow the maximum amount you can borrow. So she did. It's okay, I'm going to provide you the commodity, the resource, a real asset to go in that once you borrow. And once you have grown your money from selling that asset in the business, then you go pay off your debt. See, Dave Ramsey and Suze Orman teach you different. Say, pay your debt off first. Well, you need to grow your money first. You broke. You broke. You broke. Pay, grow that money first. Increase the little you have. Increase your paycheck first. And then you pay off the debt. Hope that helped you all. Have a great day today. Queen out.